After nearly 2 years of a Eurobond drought, not a single Eurobond being issued out of sub-Saharan Africa, you had Ivory Coast, Benin, and Kenya open the door to brand new Eurobond issuances in the region. I'm joined now by ETM Africa analyst Takutwa Ndwana. Tux, thank you very much for joining me. You wrote a very interesting report on this matter. So we saw these countries reopening the door for Eurobond issuance. What was the market's response like to this?
Thanks for having me, Ilza. The market response was very favorable, with all the Eurobond issuances being oversubscribed. In just the first 2 months of 2024, we saw Ivory Coast, Benin, and Kenya saw investors pile a total of 4.8 billion in Eurobond transactions, and these transactions alone surpassed Goldman Sachs' forecast of 4.5 billion for this year. And that figure more recently has grown to 5.55 billion, with Senegal having become the fourth country to issue a Eurobond in sub-Saharan Africa last week. Senegal issued a Eurobond to the tune of 750 million, and it's due to expire in 2031. What's encouraged investors has been prospects for looser global financial market conditions, as well as economic reforms and multilateral funding from institutions such as the IMF. And while the recent issuances show strong investor appetite, financing conditions remain difficult amid still elevated global interest rates. Issuances in Kenya and the Ivory Coast are examples of high interest rates, which have made it unaffordable for many other countries to enter the Eurobond market. For context, Kenya issued its bond at a yield to maturity of 10.4%, which was significantly higher than the 2024 Eurobond it issued at a yield of 6.9%. And Ivory Coast also faced its highest borrowing cost in a decade.
So surely with these success, and you mentioned now Senegal as well, that came out last week, other countries could soon follow suit. And obviously one of the things that could be fanning this is the significant amount of redemptions that's going to come up in sub-Saharan Africa over the next couple of years, right?
Yeah, that's correct. So we expect Angola, Nigeria, and South Africa to tap the international bond market later this year. And what's common amongst these countries is they either have a large repayment schedule or favorable fundamentals. So significant external debt repayments are looming for the sub-Saharan Africa region this year, next year. For context, external debt redemptions are set to rise to 5 billion this year and over 6 billion in 2025. When you're looking at South Africa, it has one of the biggest Eurobond redemptions over the next 2 years. It recently repaid a Eurobond of 1.5 billion in January and could refinance its larger redemption in 2025 of 2 billion. South Africa has a relatively favorable sovereign credit rating in comparison to its sub-Saharan African peers, and that's what makes it easier for them to raise external funding in a challenging marketplace. Then Angola could look to raise funding to repay an 864 million euro bond due later in 2025. Meanwhile, Nigeria also needs to raise funding to repay a 1.1 billion euro bond that's due also late in 2025.
You mentioned it a bit earlier on that it becomes tricky in the relatively high interest rate environment that we're currently seeing. We saw the Fed very recently. We're recording this podcast on a Thursday. The Fed came out last night, very clear on its stance. There it is. It will remain cautious. It even pointed to the fact that the labor market might be reflecting too strong of a sentiment, if I can put it that way. So we're not seeing the Fed preparing to budge anytime soon. How is this impacting the market when it comes to Eurobond issuance here down south?
So, with global interest rates set to remain elevated, the majority of countries that are going to issue Eurobonds in the near term are likely to be those that are seeking to refinance their bonds. These countries may do so, but it'll be at a higher cost, as seen in Kenya and the Ivory Coast. Those that seek to issue for financing of development needs and have favorable fundamentals, which are like solid growth, small twin deficits, surpluses, and low debt to ratios, are only likely to issue once there's a sustained decrease in interest rates by the Federal Reserve. On the demand side, however, given returns are still available on safer debt at present, investors are likely to continue picking carefully among emerging and frontier markets, with a focus on nations that keep a lid on spending or show progress on reforms.
Sounds interesting and interesting times ahead. So for now, still all eyes on the Fed, basically, for the rest of 2024. If you want to listen to our ETM Analytics analysis on what we can expect financial markets, both domestically and globally, head on over to our YouTube channel. Our Head of Research and Director, George Glenos, did a whole entire webinar on it. But for now, Tux, thank you very much for joining me, and we will chat again soon.
Thank you, Ilza. Thanks for having me.